What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be talking about the powers of long-term investing. And I know it's a really boring topic that a lot of people probably don't want to hear, but just given the state of the stock market in 2021, the whole GameStop fiasco, AMC, what's going on with penny stocks right now, even if you go back to last year and what happened with the Hertz stock, I felt this was a message that was much needed for my viewers or just a lot of people that are new to the stock market in general. First things first, I'm not a licensed professional. I don't, give investment advice professionally. So just make sure you take that into account when you're taking in all the information I'm giving you. This channel is meant to be informational and educational in general, right? So I will give you the information and it's completely up to you to make your own decision as to what you do with it. Do your own research. I'm just going to stress that again. A lot of people have been reaching out to me in the past couple weeks as I've been a lot more active on social media about my thoughts on the stock market and what's going on. So if you want to follow me, links to those, my Twitter, my Instagram, my Facebook are all in the description. So go ahead and take a look. But I know my sentiment has been extremely bearish on social media lately. I've tried not to be influential and thinking the stock market's going to crash in any way, shape, or form. But I'm just trying to be authentic as to the things that I'm seeing online and, my overall sentiment towards the market right now. And it seems that there's a lot of people that are, new to the market, obviously with the stimulus packages, not only in the US, but also in Canada, although it's coming in a little bit of a different form in Canada via emergency response benefits known as, CERB or CEWS, Canada Recovery Benefit, and all that stuff. What that's done is it's given a lot of people that are inexperienced in the stock market, money to trade in the stock market. And Ben Bernanke talked about this famously back in 1998 with the concept of helicopter money, where central banks would be essentially giving free money to people to do with what they please. And what it's done is essentially increased the amount of speculation in the stock market in the short term. And I don't think that, money flowing into the stock market is necessarily a bad thing. But the amount of speculation that I'm seeing is certainly a little bit concerning, okay? The amount of people that contacted me about GameStop stock, in the past couple weeks and just what happened with that, mind-blowing. I never thought I'd talk to that many people about stocks in 1 week or 1 day or in a short amount of time. So anyways, let's just go ahead and get into the video because that was a little bit long of an intro there, almost 3 minutes. Let's talk about the powers of long-term investing, okay? So principles, to me, it's kind of broken down into 3 categories. The first one is automated savings. That one's, it's very straightforward. You make a budget, you save a certain percentage of your income every month, and you put it into your investment account, whether that's a TFSA in Canada, a Roth IRA in the United States, a 401k in the United States, or an RRSP in Canada, any one of those registered sheltered tax accounts. Okay, so automated savings is the first principle. The second one is risk management, and this is an important one given what we've seen in the past few weeks, in the stock market or just in the last year. The amount of call option activity and amount of gambling going on in the stock market. The amount of people that have all of a sudden become professionals as to which penny stocks to buy, it's amazing. So making sure you're allocating your portfolio appropriately and taking on the appropriate amount of risk for your comfort level, right? What are your goals? What percentage are you aiming to make every year in your investments? What's your retirement date? What's your income? And you should really build your risk management or assessment around those things. What's your income? When you plan to retire? And how much money are you comfortable losing? That's a key question. The last principle is just, it's patience or delayed gratification, as Warren Buffett would often say.
Delayed gratification is not necessarily an unqualified course of action under all circumstances. I always believed in spending 2 or 3 cents out of every dollar I earned, saving the rest. But I've always had everything I wanted. I mean, one thing you should understand, if you aren't happy having $50,000 or $100,000, you're not going to be happy if you have 50 million or 100 million. I mean, a certain amount of money does make you feel, and those around you feel better, just in terms of being more secure in some cases. But loads and loads of money. I've probably known as many rich people as just about anybody. And I do not, I don't think they're happier because they get super rich. I think they are happier when they don't have to worry about money. But you don't see a correlation between happiness and money beyond a certain place. So don't go overboard on delayed gratification.
A lot of the times your thesis in these stocks aren't going to materialize right away, right? Because if you believe if in the efficient market hypothesis or anything along those lines that all public information available is appropriately priced in these stocks, I mean, it would take time for your thesis to unfold because you would essentially be predicting future events instead of what's publicly available to you. So automated savings, risk management, and just delayed gratification or patience in general, those are the main principles to long-term investing. Next bullet point here is the benefits of long-term investing, and there's a lot of them, okay? I'm just gonna run through, again, high-level breakdowns. The first one is it eliminates stress, right? You're not thinking about, intraday movements of stock prices or your investments. You're basically automating your savings, putting your money into, let's say, a mutual fund or a blue chip stock, and it's eliminating that stress. You're not worried about the 60% up or down days like we saw with some of the penny, like that we do see in penny stocks or that we saw in the GameStop fiasco. You are taking a lower level of risk and ultimately preserving your capital, okay? And what that's going to do is it's going to eventually build generational wealth for you as you grow old, okay? So the benefits of long-term investing: reduce stress over, I would say, day trading or speculative gambling in the stock market, and you're going to be generating generational wealth. The next thing I want to talk about is the actual monthly savings required to become a millionaire by retirement, okay? And what I've assumed here is retirement for everybody is 65. That's when most people usually retire. Some people, take less time. Most people desire to take less time, but aren't able to get to, that magic number of the required amount of savings that they need in retirement by that time. And then I've also assumed that you can make at least 7% a year in the stock market. That's, I would say, kind of high, but on average, if you go back to the S&P 500's inception, it has averaged about 7 to 8% since inception. So I'm assuming, let's say you are just buying and holding the S&P 500, and what it's done for the last 100 years continues for the next 40, 50 years or until your retirement, which is about an average of about a 7% return. And you're going to see the amounts here are going to jump significantly as you get older, and that's why the benefits of compound interest are so important. Actually, I should have mentioned that in the benefits of long-term investing point. Compound interest is the biggest benefit of long-term investing. Just holding a blue chip stock that pays a good yield, or achieving that 7% a year return and just seeing your interest compound over time. And that's really evident in the numbers here in the required savings to be a millionaire, okay? So let's say you're 20 years old, you want to be a millionaire by the time you're 65. The minimum amount of dollars that you need to save every month, assuming you can achieve 7% a year, is only $255. Fast forward and you move to the age of 30, that's now more than doubled, and it's going to be $525 a month that you need to save in order to be a millionaire by retirement. Fast forward to 40, again, it's more than doubling, and you need to save $1,125 a month in order to reach that $1 million mark by 65. So obviously, as your time period shortens here, the amount of monthly savings required is going to elevate drastically. And by the time, if you don't start till 50, you almost need to save $3,000 a month to hit a millionaire, or to hit $1 million by the time you're 65. So I hope that's good information for you guys. Basically, what I'm stressing here is that you start investing early and you focus on preserving your capital instead of gambling. And I don't want to come across as a hater here. I know certain people that have made money in some of the penny stocks this year, and some of the more speculative buys. And I applaud you. That's great, and I hope you continue that. But in most cases, these people that I have been talking to, and in most cases in the past as well, the people that are able to make these huge returns in a short amount of time are just as subject to give that money right back to the market on their next bet. So the amount of risk you need to take to achieve that amount of gain in such a short period of time is so elevated that you're just as likely to lose your capital as you are to grow it. So that's why I'm stressing the power of long-term investing. I'm a long-term investor. That's always been my style, a little bit more conservative, I would say, in nature with my investments. So that's why I'm preaching this today. A couple of things to avoid, when you're investing for the long term is obviously gambling. You don't want to be predicting short-term price movements. I would say absolutely nobody on the market can, whether you're looking at fundamentals or technicals. Nobody knows whether a stock, any given stock or investment, is going to go up or down on a given day. You can have a forecast or a prediction, sure, but the ability to tell when or why that price may move is pretty much impossible. So I just again want to preach the need to invest for the long term. These theses on your investments often take a long time to unfold. So saying that one stock's going to jump 100% in the next month or even the next week, or day or whatever, that's just pure speculation in my opinion, and not a good principle to preserve your capital over the long term or for retirement. The last thing is to avoid any emotional bias when you're investing. Obviously this is easier said than done, but for anybody that, let's say, held their investments through the coronavirus crash of 2020 in March there and sold as it was going down 30%, well, the market's only been up from that point. So the whole point of long-term investing is it's not about buying and selling at the right time. It's simply adding to your position, or dollar cost averaging your position as it goes lower in events like that, and just adding more cash to it. You know what I mean? It's not about timing the market or in any way. It's about sharing interest and dividends over time that's going to eventually compound your wealth and make you a millionaire, and make sure you have a happy and prosperous retirement, and hopefully build generational wealth for your family, or the next generation of your family. So yeah, anyways, that's all I have for you guys today. I hope you guys enjoyed. If you guys found this useful, helpful, enjoyed the content, learned something, share it with a friend, subscribe to the channel, and yeah, that's it. I'll see you guys in the next video. Peace out.